The European Commission today proposed a ban on proprietary trading on banks in Europe. We caught up with Mario Nava of the European Commission to find out more. What's the motivation behind the reform and why the ban?
Right. The European Commission in the last few years has done the most ambitious reform, financial reform probably in the world. We have not only deployed all the rules that have been agreed at the G20 levels, but we have also gone beyond what has been agreed at the G20 level. That's the reasons why in the past we have done all the rules on prudential requirement, resolution rules. Today we enter the area of structural reforms, and structural reforms is essentially for the very big banks. Our reading of the situation was that we have very good prudential rules in place for all banks, but there are still some issues to solve in the so-called too big to fail, too complex to fail banks, and we wanted to resolve that.
Today's proposal would ban proprietary trading. What is understood under proprietary trading? What activities?
Today's proposal bans the proprietary trading on own accounts of all the banks. That's making it impossible for a bank to profit for its own benefit, to make profits on financial activities, and it incentivizes banks to go lending to the real economy. And it links very well with the spirit of the reform till now.
And what types of activities, for example, would be covered?
Basically all type of proprietary tradings with some very narrow exclusions like sovereign bonds or some types of funds which have social or long-term finalities. But all the other, like hedge funds, like proprietary trading in general, like even speculation on physical commodities, all that is covered.
And how do you enforce this ban? Who would be responsible for supervising and sanctions?
This is a law. So the law is a regulation. A regulation is a law that in Europe is directly applicable, doesn't need a national intermediation. And this regulation foresees also sanctions in case banks do not comply with the law. This is a law that speaks to banks and says to the bank, thou shalt not do this or that. So there are sanctions, and in case there is, of course, the power of the supervisors to intervene.
This ban would cover about 30 of Europe's largest banks, and proprietary trading right now is only a small part of their balance sheets. So why target this kind of activity? What's the risk?
This regulation covers banks which are above a certain threshold in trading activities and in global assets. For the time being, according to the data today, there are about 30. By when the law will enter into force, we'll have to see with the new data, but we estimate the ballpark is that, between 30 and 40. The law does two things. One, ban proprietary trading, as you have been saying, but two, it also gives the power to supervisors to look at all the trading activities, all the market-making activities, identify area of risks, and eventually, or possibly, asks for a separation. In that respect, the law therefore gives a large possibility to the supervisors to go beyond the area that you say that today is small. By the way, today is small, but it used to be much larger in the past.
And is there a risk that it could become larger again?
Well, if this regulation is adopted, no, because of course with this regulation adopted is not possible. Had this regulation not been proposed and therefore not adopted, maybe with markets in better conditions and whatever, we don't know, but it could have become large again.
Finally, in the US, you have the Volcker rule. How does this measure differ from the Volcker rule?
Well, the ban on proprietary trading is similar in spirit. There may be a difference at the definition level. We define it at the level of the desk. So desk doing exclusively proprietary trading are banned, but that in spirit is similar. Plus, we have the very large review of all the activities, and that I think is a European specificity.